When diving into stock market investments, due diligence is very crucial, and here's a quick guide. First, you need to check the company's financials. And by doing this, you are looking at the balance sheet, the income statement, and the statement of cash flows. And they are what you can call financial statements. We will discuss more about these in later videos and go through how we can actually interpret these financials. Second, leadership. Look into the management team's background and track record. Just have a look if the CEO or the board members of that company are actually making decisions and what's best for shareholders, which are us. Business and industry, understand the company's model, competitive composition, and industry trends. Let's say, for example, you are investing in a company, you'd really want to know what their competition are, because if there are so much competition within that industry, then that might mean that they'll be spending more on research and development, and that could also mean that they're going to cut off some profits because they're spending more on R&D. That's not always a bad thing, but it could decrease the bottom line in the short term. Risks. Identify and assess potential risks the company might face. I will discuss this in detail on how we can identify those risks by looking at annual reports. Compliance. Ensure the company complies with regulations and legal requirements. The last thing that we want is to invest in a company that does not comply with regulations, and the government could just file a lawsuit against them, and that could also disrupt or cut down the bottom line, and that means less profits for you as a shareholder. Understand the market conditions, consider economic factors and market conditions. Governance. Review corporate governance practices. Are they complying with regulations? Are they doing good decision making that is in the best interest of shareholders, or are they making decisions that takes more money to their pockets? That's for you to find out. Dividends and buybacks. Check dividend history and share buyback policies. Although, just do note that not every company gives out dividends, mainly because they are still growing and they could use that money to invest in other areas that increases the value of the firm, which is a good thing because that increases the share price in the long run. Stay updated with news and events. Although some news are practically noises, it's always good to keep on track with the news and events about this company, especially when they're due for quarterly filings. Valuation. Evaluate the company's current valuation. This There's a lot to do with doing this, and it requires financial concepts which we could discuss later on. Diversification. Ensure the investment aligns with your portfolio goals. This is up to you whether or not how you are going to spread your cash among many baskets. That is totally up to you. If you want to just invest in one company, that's that's okay as long as you're actually doing due diligence, but I would not recommend that, especially as a new investor, and especially because there could be other ways to manage your portfolio that gives you better returns rather than risking it all in one basket. Keep in mind due diligence is ongoing and staying informed is key.